So different types of profit. I'm an economist. Naturally, I favor economic profit. Your accounting professor is an accountant, and he favors a different type of profit. It's called accounting profit. It's different. It's not as useful for some purposes as economic profit. They like accounting profit not because they're stupid, but because accounting profit is useful for other types of purposes. So don't take sides and think there's a debate. There isn't any debate. If you're trying to allocate resources efficiently, there's no debate that accounting profits are a stupid way to do that. The accountants would agree with that. And the economists would agree that the accounting profits are applied in cases often where it's just the right conception of profit to be thinking about. So just know that there are two types of profit. Accountants and economists think differently about them, but they each have their advantages. And well, I won't say ours has any disadvantages, but I guess if it's not as good for some purposes, then I must implicitly mean that. Accounting profit is the total revenue you get minus everything you pay out in explicit terms. Writing a check, making a credit card payment, giving cash, anything that you actually make a payment to buy for your firm is an explicit cost. And the accounting profit is just the difference between revenue and those costs. Economic profit is the difference between your revenue and all your costs, implicit and explicit. There's another vocabulary word you need to learn, which is normal profit. That's the implicit cost of the resources you supplied or the owners supplied to the firm. You need to know what the terms mean and how they're used. They're not complicated. If diagrams help you, here's one that summarizes. Think of the pie chart on the left as all the revenue that comes into the firm. The costs that the firm incurs explicitly are the big wedge in the middle chart. Everything else is accounting profit. That's the number that the firms announce when they do their quarterly earnings announcements. It's all the money they took in minus all the money they paid out. Explicit costs are the same wedge here, but we divided accounting profit into two subcategories. The cost of the resources that you supplied to the firm, that's an implicit cost, and anything above that is economic profit. So your normal profit is just reimbursement for the costs you incurred by supplying your time, your capital, anything else you supplied to the firm. If you get more than that, terrific. You're getting more than you put in. You're not just getting paid back for the costs you incurred, you're getting that plus some. That's your economic profit. I'm going to try to illustrate the distinctions with some extreme examples. They will seem silly, but if you look at extreme examples, sometimes the principles stand out in sharper relief than if you look at ones where the differences aren't exaggerated. So here's the business that we're going to look at. It's a miniature golf course in Odessa, Texas. Cullen Buffett is the principal of this business. He rents the course from a company. I'm setting it up just to keep it simple. So he pays the company $1,000 a month in order to have access to this facility. He charges people admission and he supplies his own labor. He likes managing this golf course just as much as he would have liked working in a grocery store for which he would have gotten paid $800 a month. So maybe he liked that job, maybe he didn't like it, doesn't matter. It's the same on those dimensions. The $800 in pay is what he gives up by not working in that job. And his monthly revenue from selling tickets to people who want to play on the carpet golf arena are $2,000 a month. What's his accounting profit? What's his economic profit? There are clear, unambiguous answers to these questions. So the accounting profit is $2,000 a month of revenue The only explicit cost he has is the $1,000 check he writes to the company that makes the course and maintains it. So his accounting profit, $1,000 per month, period. Economic profit, that amount minus the implicit cost of his labor, which we established was $800 a month. What about the fact that he doesn't like the job? Well, I'm ignoring that because he didn't like the grocery job either, and he didn't like it by the exact same amount. If I wanted to do a formal accounting, I would try to factor that in too, but I'm ignoring it because it's not a difference between the two activities. Okay, that's our baseline measure. We've got accounting profit in this operation of $1,000 a month. We've got economic profit, that's $200 a month. Anybody want to challenge either of those numbers? Before you ask your question, let me ask if anybody wants to challenge either of those numbers. No, that can't be the accounting profit. Or you're crazy if you think that's the economic profit. Anybody have an objection to either of these numbers? I don't think they're controversial. It's just definitions, and the example strips out all the complexity, and that's what we're left with. These two unambiguously correct answers to those questions.
I just wanted to make sure I understood the concept of normal profit. So
Okay.
is the normal profit in this situation equal to 800?
Yes.
Okay.
Yes. Yeah, that's his economic profit. That's his, the 1,000 was his accounting profit, and that's his explicit cost. I mean, his opportunity cost of his time. His normal. So now the situation changes because he has a new opportunity. His uncle has died and bequeathed to him a piece of real estate in New York. It's bounded on the north by 59th Street, on the south by 58th Street, east and west bounded by 5th and 6th Avenues, respectively. If you don't know Manhattan, this is what might be called a centrally located parcel in the city. There's a lot of foot traffic on the sidewalks surrounding this parcel. And so his question naturally is, should I relocate my business to Manhattan? So he finds somebody who's willing to tear down the buildings that are currently erected on this site and then construct a much larger and more elaborate miniature golf course on the site. And the cost of doing that for him will be a payment not of $1,000 a month, but $4,000 a month. It's a bigger site, and so they charge a lot more for the construction and rental of the course. He does a market survey and discovers that the news isn't all bad. Sure, it would cost more to run the course there, but you'd get a lot more foot traffic and hence a lot more business. He would get revenue each month of not $2,000, but $16,000. So the question is, what's his accounting profit if he opens his business there? I'm assuming that the cost of living is the same in the two places, just to make it convenient. But, you know, if you really wanted to do a holistic analysis, you could say, life's interesting in New York, life's uninteresting in Odessa, and sure, I'd pay a little bit more for things in New York, but that's exactly offset by the fact that it's more interesting there. So that's the assumption essentially being made here. So if he opens the golf course in New York, what's his accounting profit? That's a number. It's the revenue minus the explicit cost. And it so happens that it's 12 times as big as his accounting profit is in Texas. He was making $1,000 a month there, now he's making $12,000 a month. Here's some more information. Suppose the parcel of land could be liquidated in its current form for $100 million. Does that seem like a reasonable estimate? It's not really. How's it off? This land's worth way more than that. Way more than that. Kushner bought a building on Fifth Avenue. One building for $1.8 billion. Now they're, it's a mortgage coming due. They don't have any money to pay the mortgage. They're trying to get people to help underwrite it. And so one of their plans is to tear the building down and build some new building on it. But the reckoning is that the land's more, the thing they own is more valuable without the building than with the building, because the building is kind of crappy that sits on it. So if they're trying to liquidate that property or get people to back it as if it's worth $2 billion, then this much, much larger parcel is probably worth even more than that. So not a far-fetched example to use for the value of the land. The interest rate that he could get by putting the money in the bank wouldn't be 1% a year in any bank I know about, but if he bought the right stock, maybe he'd get more than 1%. Not 1% a year, 1% a month. He'd get more than 1% a month, maybe. So we're not sure what the opportunity cost of the capital. Just suppose it's 1% a month for the sake of discussion, okay? So what's his economic profit? We're going to just calculate the number. And should he relocate it to Manhattan? The answer will be yes if his economic profit would be higher there, and no if his economic profit would be lower in Manhattan. The accounting profit is absolutely not relevant for answering the question, should I relocate? That's a resource allocation question, and it should be answered by comparing the economic profits in the two locales. Okay, what's the implicit cost of the land? It's the money he could have gotten if he'd put that money in the bank, and that's $1 million a month using the simplifying assumptions I made. $1 million a month. We're talking real money to use the plot of land for any purpose. You know, that's what it's going to cost you. Okay, so what's his monthly economic profit? It is got a big minus $1 million a month as one of the costs. So it's the revenue of $16,000 minus the $4,000 payment to the company that built and maintained the golf course. He could have earned $800 at the grocery store. He didn't. If he'd stayed at the golf course, he would have paid himself that $800, plus he would have gotten $200 over and above that as his economic profit. If he moves to New York, he loses that money entirely, and then the $1 million. So what's his economic profit? It's a number. It's minus $989,000 a month. Should he move to Manhattan and run his golf course there? No. That would be the height of folly to do that, as is immediately obvious from the ridiculous numbers in the example. But if all you knew about was accounting profit, you'd say, yeah, hey, I'm going to make 12 times as much if I move there than if I stay here. Chandana. I'm comparing what happens if I stay there with what happens if I come to New York. I'm going to get $1,000 if I stay there. I won't. I'm not going to do it. I'm going to run the golf course if I stay there.
But if you run the golf course, then you've already accounted for -800 in that.
If I stay in Odessa, I'm going to pay the company that gives me the golf course to use $1,000. I'm going to get $2,000 revenue. So what do I have left if I stay there every month, free and clear? $1,000. If I leave there, I lose every nickel of that. You don't want me counted? What part of it don't you want me to count?
So to get to the 200, you've done 2,000, which is the revenue, minus 1,000, which is the explicit cost.
Yes.
Minus 800, which is the implicit cost.
Yes. So I'm giving up not only my economic profit that I would have earned in Odessa, but also the implicit salary I'm paying myself there.
I think what she's trying to say is that there's three scenarios here. 16,000 minus 4,000 operating the golf course in New York City, 800 and 200 operating the golf course in Odessa, 1 million selling the parcel. So it seems like
I'm
there's two
saying
scenarios.
exactly what I meant to say. There's not three things I meant to say. I'm saying, here's the economic profit I get if I run a golf course in New York. And that is the revenue I'll take in, minus the explicit payment I make, minus everything else I have to give up to do it. And what do I give up? I'm giving up the 1,000 I would have taken out of the golf activity in Odessa. And then I, in addition to that, take out the implicit cost of the plot of land. Now, look, I've taught this example for some years now. I know everybody's agitated. How come you're counting this? How come you're counting that? I've accounted for it in exactly the right way, and I'm happy to talk to you about it at great length if you want to. But I think the best thing to do for you would be for you to go back and think about it, and then come and talk to me or send me a memo. Here's why I think you did it wrong. The question is, what am I giving up if I move to New York? What am I getting if I move to New York? I'm going to get. That's the only thing I'm getting. What am I giving up? I'm giving up 4,000, 800, 200, and a million. I'm giving up all those things if I move to New York.
Quick question. Wouldn't be the basis for decision-making management costs rather than financial accounting? And wouldn't that include future costs as well? Or am I wrong there?
I don't know anything about any of that. This is the economic profit that he would get from. This is the way a dumb economist would calculate the profit from operating the course in Manhattan.
Doesn't this tell him he's in the wrong business altogether, though, that he should just be a real estate developer?
Yeah, he shouldn't move to New York to do a carpet golf business, is what it's telling him. Why? Because look, it's a loser. He should probably not stay in Odessa either. He's got $100 million of capital he didn't used to have before. He can get $1 million a month interest on that. Maybe he could, spend more time walking his dogs or whatever else gives him tutoring kids who are doing poorly in school. A lot of things he might want to do because he has that money that he wouldn't have thought to do before. I'll take one more question.
So is the reason
From Miss
you think
Keitan.
$100 million included in there because it's not the monthly economic profit? So, 'cause he would
That's
pay
the
that
monthly
$100.
cost of tying up the land in this activity. It's the interest you could have earned had you sold the land and put the money in the bank. It's an implicit cost, but it's a cost. No more. Think about it and then come and argue your case. You think that's not the economic profit? Yeah, tell me why. I don't want to be doctrinaire, but I have an obligation to keep the ball moving here. I know people get ruffled when they see that line. Think about it. Digest it a little bit and then see how you feel about it. Maybe it won't seem so jarring to you when you think about it for a moment. Okay, he should stay in Odessa is what the calculation tells. And the main point of the invisible hand idea is that competition over the course of time will drive economic profit in all competitive endeavors down to zero. If a firm's earning positive economic profit, it will attract people sniffing around trying to get a piece of the action. Here's a guy running a business. He's getting more out of it than he put into it. That's a good deal. Why can't I get some of that? People will ask. Other firms could buy the same resources he's buying and supply the same resources he's supplying and get more than it costs them to do that. Then you end up wealthier than you were before. That's a good deal. So there will be entry, and when there's entry, it will continue until there is no cash on the table. There's cash on the table initially, good. People will enter, and they'll keep on entering until there isn't any cash on the table. It happens automatically. You don't need a committee to tell firms to enter. They just enter because there's cash on the table. If they're earning losses, that is to say, if their economic profits are negative, they'll leave. They won't stay. Why should I stay if I'm losing money? I could go earn zero economic profits somewhere under normal circumstances. Maybe there's even a fleeting opportunity available to me to earn positive economic profits. I'll move there. That's better than staying and continuing to suffer losses. So go out of business or move somewhere else. If firms leave, what happens? Prices go up. There's less competition. The supply curve shifts in. So in the long run, the expectation is there will be zero economic profit when the industry we're talking about is one that's subject to competition. That's the so-called invisible hand mechanism. Doesn't mean that everybody will behave in a way that results in the best possible outcome for society as a whole. They may do horrible things. In Houston, people developed their parcels so that huge proportions of the land in the city was completely impervious to water. And what that meant was when there was a heavier than expected storm, there was no place for the water to go. And you saw what happened. Why did they do that? Because it was individually in their interest to do that. If you want people not to do that, you need a zoning regulation. You get too much money if you fill your lot with whatever the profit maximizing thing is, and there will either be a flood or there won't be a flood, not as a function of what you do on your lot, but as a function of what we do on all the lots together. So individuals have no incentive not to build in that way. If you want them not to build in that way, you need to make it not in their interest to build in that way. The no cash on the table principle doesn't guide people to the socially optimal pattern of behavior in all cases. Sometimes it does, sometimes it doesn't. So don't mistake what I'm saying about the no cash on the table principle as a statement that it leads to the best of all possible worlds under all circumstances. It does not. We put too much CO2 in the air. That's part of the reason that the scientists believe that such an unusually bad storm occurred in the first place. I hope no one is offended if I say that there is a strong scientific consensus that human deposits of greenhouse gases have contributed to the frequency and severity of storms like this. If you're offended, go complain to Betsy Dick. She'll tell you, suffer through it. It is a scientific consensus. There are people in America who don't know that, who think it's an open question whether any of this is to do with greenhouse gases. But the scientists don't believe that. One response, well, I'm not a scientist. How can I have a position on that? Of course you're not a scientist. I'm not a scientist either. But that's why we ask the scientists what's happening. Not all of them are in the pay of fossil fuel producers. They're most of them trying to figure out what's going on. They're doing tests. They're gathering data. Most of them are giving an honest opinion about what could they be wrong. Sure, but do you want to bet that they're wrong? Bad policy. I'll get complaints, but do I really want to teach a course where I think, well, on the one hand, there could be increasing temperatures going on, but maybe some people believe the Earth is flat. There are two functions of the price system. One is to make sure that the supplies that exist go to the people who value them most. That's the allocative function. That's the rationing function. The allocative function is to draw resources into arenas where they could add more value and push them out of arenas where they're not adding sufficient value. That's the allocative function of price. Those two functions are important. And the rationing function doesn't ration goods to the people who get the most utility from them. That's not what it purports to do. It rations goods to the people who are willing to pay the most for them. If you hook people up to a utilimeter and feed them a good and see how happy it makes them, the people who are made most happy by that good won't be the ones who get it necessarily. The people who get it will be the people who are willing to pay the most for it. Sometimes those will be the people who get the biggest bang from consuming it, but other times it'll be people who don't care that much, but they happen to have a lot of money, and so they're willing to pay a lot for it. And you will see examples of times where somebody will bid successfully for a scarce good that he doesn't really care about. Another person won't get that good even though she desperately wants to have it because she can't afford to bid the market price for it. That's a feature of the price mechanism, and there's no sense running away from it and pretending that it's any different from what it is. It is what it is. I tried to argue to you last time that using willingness to pay as a measure of economic surplus, as the benefit measure, still makes sense when you're trying to say, how can we make the pie bigger? We base that assessment on what you're willing to pay. Then we can make trades, and we can redistribute in ways that try to assure that everybody gets a bigger slice than before. So profit is a carrot, losses are a stick. They're trying to allocate resources efficiently, not only in the sense of letting the people who value the things most be the ones who get them, but also producing the right mix of things in the first place. Okay, what if we're in a situation where the firm is earning economic profits? The left segment here is the supply and demand curve for the good in the market. Notice the difference in the units here, millions of bushels a year. That's the whole market supply curve, the whole market demand curve. That's where the price comes from. The firm, a much smaller scale, reacts to the price. It chooses the quantity for which price and marginal cost are the same. That's the profit maximizing condition. It produces 100,000 bushels a year. Its profit is the difference between its price and its average total cost at that level times the number of units of output. And that's the area of the pink rectangle. This average total cost figure is the whole sum total of costs that are incurred by this firm, implicit and explicit, divided by the quantity it produces. There's nothing left out. So if we were talking about some land that the firm owned, we would include the implicit cost of keeping the land occupied in the activity that we're talking about here. People see that pink rectangle and they say, I want some of that. I could enter this industry, my cost would be that amount, my benefit would be that amount per unit, I'd get a big pink rectangle full of extra money. And so what would happen? Supply would shift to the right in that industry. That would mean prices would go down. The excess profit or the economic profit, both those terms mean the same, would be smaller than before. What would happen once we saw this shift? Well, there's still economic profits, and that's not stable. A situation is not stable if there is cash on the table. In equilibrium, there's no cash on the table. There is cash on the table here. It's not stable. What will happen? There will be more entry. And so supply will shift to the right again, and price will fall again. And it will keep happening until we get to the new equilibrium, where there will be no incentive for further entry to occur, because look at the nice properties of that point. Price, the value of the last unit produced, is exactly equal to the cost of producing it. The firm earns exactly enough to cover its costs of production, not a penny more or less. That's an incredibly neat, elegant set of characteristics for the equilibrium that emerges in the invisible hand story. It doesn't mean people don't pave their lots too full. It doesn't mean they don't discharge too much CO2 into the air. It means they're doing the best they can given the rules of the game that they're operating under. Okay, no cash on the table. What if they're earning losses? Then it's the reverse. You're earning losses, get out of there if you can. If you think that's a persistent state, you don't want to stay there. Supply shifts to the left or up equivalently. Price goes up, and it keeps shifting until such time as you end up again at the point where there is no cash on the table. Okay. If you understand the no cash on the table principle, you can answer all sorts of questions that somebody can't answer who doesn't understand it. That's why it's useful. And these questions, even though I'm going to pose them in hyper-exaggerated form, some of them, they actually resemble situations that occur frequently and naturally in the kinds of markets you will be observing as you go out into the world. So, how much should something rent for? Rent is a very different idea than profit. The rent to a factor of production, as economists use the term, you would say, what's the least somebody would require to be willing to supply that factor of production? How much do they get paid for supplying it in the market? Well, that will in general be a number more than the least they'd be willing to accept for supplying it. So the difference will be a rent. It's not technically the payment you make, it's the amount over and above what they would have needed to be willing to do it. So we're going to try to apply the idea of rent to the payment for agricultural land that is rented. Normal agricultural land yields 50 bushels of corn per each acre each year. This is just the productivity figures I'm giving you. Corn sells for $1 a bushel. A farmer can farm 500 acres, and if he does that, it's the same amount of effort, physical and psychological, as he would have had to expend working in a factory. Two options: factory work, farm work. You're a tenant farmer, you rent your land, you grow your crop, you sell your crop, you pay your rent, and you keep whatever's left. That's the way this example is structured. The factory job pays $10,000 a year. Again, you could say, well, how do you feel about it? Isn't that relevant? Yes, it would be relevant if it were different from how you felt about the farm job. But since we're talking about choosing between the two jobs, we can ignore how you feel about it, plus or minus, because it's assumed to be the same and won't be a factor in choosing between the two jobs. Okay, land and labor are the only two costs of farming. What's the normal agricultural land going to rent for? Somebody who didn't know the no cash on the table principle wouldn't have any idea what to do in response to that question. But you all know it, and so you're able to answer this question. That might not seem like a big deal, but you'll see other applications where this insight will be very fruitful for you indeed. So the total revenue from farming we know to be $25,000 a year. How do we get that? 500 acres times 50 bushels per acre times $1 a bushel from the sale of the corn, and that's what you get. You get $25,000 a year. Your total costs are $10,000, that's the implicit cost of your labor, plus whatever you have to pay for the rent on your land. That's 500 acres times rent per acre, okay? And here's where you use the no cash on the table principle. If this market's going to be in equilibrium, which is what has to happen for the no cash on the table principle to apply, there will be zero economic profit. So what's the rent need to be in order for that condition to hold? It needs to be $15,000 a year for the parcel, and since the parcel is 500 acres, what that means is the rent has to be $30 per acre. If it's a penny more than that, farmers will want to leave farming and go into working in the factory. If it's less than that, Factory workers will say, why should I work here? I could make more money if I went to bid for farmland and became a farmer, but in the process of bidding for the farmland, they would bid the price of it up until that wasn't true. All right, so now we can answer questions that trade on that insight. We've got a premium plot of land. Maybe the orientation's different, maybe it's better watered naturally, maybe it has better soil, whatever the reason, you can grow twice as much on this plot as you can on normal land. Twice as much. Normal land, how much did it rent for? Everything else is the same in the example now. What did the normal rent for? $30 an acre. What's the rent for this parcel going to be? It's twice as productive. 60. 60? 60 is the wrong answer. It sounds like the right answer because the land's twice as productive. If a worker's twice as productive, won't he get paid twice as much? Yeah, under many circumstances, that's exactly what will happen. Here we need to actually make use of the no cash on the table principle and figure out what the rent should be in order for it to be satisfied. So let's do that. Total revenue is going to be twice as much as before. Why? Because the land's twice as productive. That's the difference. The cost is going to be the implicit cost of your labor. That's the same as before. And the land rent. Economic profit, total revenue minus total cost. That has to be zero if the market's in equilibrium. And so it'll be $50,000 minus $10,000 minus the land rent. What's the land rent have to be in order to satisfy the zero profit condition, the zero cash on the table condition? It has to be $40,000. And what that means is that the land is going to rent for $80 an acre, not $30 an acre. There's no surprise there. But if you don't know the no cash on the table principle, you can't answer the question. You're stumped if you're confronted with that question. And nobody would say that the no cash on the table principle is irrelevant for thinking about this. What if the rent for the land was only $50 an acre or $60 an acre, twice as much? What would happen? Tell me the story. There is now cash on the table, but you're not done. So what do you do? So there's cash on the table. Who's going to want to do what? The farmers, no. Who's going to want to do what? The farmers are delighted that there's cash on the table. The factory workers are going to see that cash on the table and say, what am I doing in this factory? Those guys are, with the same amount of effort I'm expending, they're getting more money than me. So I want to be a farmer. Well, to be a farmer, I need land. But there isn't any land. The land's being used by the farmers. So what do? I bid it up. You're renting your land to him for that? Oh, you're crazy. I'll give you, he's paying 60, I'll give you 65. And then somebody else will be frustrated and he'll offer 70. And the land rent's going to end up being 80 by the time that narrative stops unspooling. Does anybody not like that story? How can you not like that story? That's the most elegant story anybody's going to put in front of you the whole time you're here. It's extraordinary. If you don't know that story, you won't understand what's going on out there. I hope I'll persuade you with some more examples that that's true. All that's what we would predict to happen if you believe that there's no cash on the table. I should say again, when I say there's no cash on the table, I don't mean there's never any. I mean it doesn't sit there forever. If there's cash on the table, that's going to set in motion actions that will eventually result in there being no cash on the table. That's the way you need to understand that principle. It has policy applications. Suppose the governor of California wants to get you to vote for his proposal. You're a legislator. he wants to put in a new irrigation system in this place that they can't grow much, and so the tenant farmers there are doing poorly. They're not earning much. If we put the irrigation system in, right now the land is parched. They can barely grow enough to keep themselves alive. We're going to put in this new system. It's going to be a breadbasket. They're going to be able to grow vast quantities of stuff. Do you vote for that? If the claim is it's going to make the lives of the tenant farmers better, your response should be, that's a dumb proposition because it doesn't take into account the no cash on the table principle. What's going to happen here if you enact this policy? Yes, the output of the land will go up because now there's water there. What does that mean? That means factory workers who decided it wasn't attractive to be farmers are going to say, suddenly, I want to be a farmer. Look at all you can grow now. They're going to bid for land. They're going to bid the price of the land up until such time as the amount you get by working on a farm is the same as you'd get if you'd stayed in your factory job. So if the governor wanted to increase the incomes of tenant farmers, he picked a bad vehicle for doing that. And if you were his economic advisor, you could tell him that, and he would maybe think harder about a better way to try to assist the group that he's trying to assist. Give them some more money, maybe. Should we have an irrigation system in this area? Maybe, yeah. If the benefits of it would exceed the costs, yeah, maybe we should have it. But should the taxpayers pay for it? Why should they pay for it? The benefit's going to go to the landowners. Why should the taxpayers be assessed taxes to pay for a benefit that's going to go directly to them? Siddhesh.
When factory workers leave their factories and bid the prices of farms up, won't that also increase the amount that you need to pay each factory worker because the supply of...
Yeah, if we had a full general equilibrium model, but I'm assuming that there's an elastic supply of factory workers, and the number of people who do that is essentially without limit. So that's the constant opportunity cost of farming, is what you could earn in this. You know, it's like being an Uber driver. You know, you could just go and do that instead.
Since this is food, though, and what's the alternative that they just grow a crop that can grow in low water conditions? And
Yeah,
okay.
yeah, that's what they're doing now.
Okay.
And they're not making much money.
And there's enough.
If you put water there, they'll continue to grow food, and they'll grow more of it, and they won't make very much money. So if your aim was that you wanted them to make more money, that's not the way to do it. Maybe you need to give them a training allowance. Maybe you need to get them a bus ticket. Maybe you need to do something that would get them into a situation where they would be more productive or have some other means of getting more money, but just putting in a system that will get them to bid up the price of the land that they have to rent to grow their crops is not going to do the job for them. One last question.
From the farmer's point of view, if you're increasing your land costs, aren't you acting against your own interests?
If I'm a tenant farmer,
Yes.
yeah, I'm saying that this doesn't help the tenant farmer. The tenant farmer isn't increasing the land costs. The policy change is increasing the land costs by making it more valuable.
Previous example, where the rent per acre, wouldn't you want to minimize the rent? So why is cash off the table? Why is taking cash off the table good for the interest of the company owner? If they want extra
Nobody's in charge of any of this. Stuff happens. If there is cash on the table, meaning you could make an economic profit by farming, people will quit factory work and try to become farmers, and that's because they're trying to harvest some of the cash they see on the table. The effect of that will be to bid up the land price, which will leave farmers exactly where they were in the first place. Not because they want to do that, that's just what happens. That's the consequence. If you have, yeah, come when you're done, and I'll take more questions after class. Okay. No cash on the table. Keep coming back to that. If you want an irrigation project, yeah, maybe it's a good thing. Maybe the benefits exceed the costs. But then why shouldn't the landowners be the ones who pay for it, since they're the ones who will be directly capturing the benefits of it? Do they need government financing? Maybe they do. Maybe it's a big capital project they can't afford. All right, so then that's a government intervention that maybe you'd want to, but a giveaway to the landowners to build their irrigation project for them? Why would you do that? There are other uses for money that are productive. You don't need to do every dollar in a purpose like that. Here's one that will strike close to home. Imagine that I'm talking about you in this example. There's a firm, like all the other firms in the industry, except it employs you, and you happen to be an extraordinarily talented manager. Because of what you do, and only you can do, the firm earns an economic profit of $500,000 a year. All the other firms in the industry are normal. They have normal managers, people who aren't like you, and so they earn 0 economic profit a year. Okay? That's the assumption. If you, this manager, you receive the same salary as all other managers, the firm that hired you would have lower costs and hence make these huge economic profits. Is this a stable outcome? The answer is no, because there would be cash on the table. There's no cash on the table in stable equilibria. Well, all right, you say there's cash on the table. That's not good enough. I need a narrative. Who's going to want to do what here? The owner of your firm is making $500,000 a year economic profit. There's cash on the table. Who's going to want to do what?
You would want to threaten your employees that you would leave unless their salary.
Yeah, you might want to take action, but there are others who might want to take action.
Other firms are going to bid for you.
So you're the manager of one of these, you're the owner of one of these other firms. You've got an ordinary schlub as your manager. You're paying him the normal salary that managers everywhere get, including you at your firm. You're going to say, look, the owner of that firm, he's not talented. He's just, he lucked out. He hired this Johnson graduate who is unbelievably effective as a manager. If I had that guy working for me, I'd get $500,000 a year in economic profit. Well, let me meditate on this and see if I can figure out a way to get that guy to come to my firm. What might I do? I might offer him more than the normal manager's salary to consider. So maybe the normal manager's salary is $200,000. I'm going to offer this guy that amount plus another $300,000. That would get your attention, I'm going to say. $300,000 extra? I'm only making $200,000 now. That's more than double my salary. I'd consider moving for a premium like that. So you move. Now he's making an economic profit. How much of an economic profit is he making? $200,000. The firm he left was making $500,000. He's making $200,000. Is that a stable outcome? No, there is cash on the table still. Who's unhappy? Who has an incentive to act? The owner of one of the hundreds of other firms who have ordinary managers. They're going to offer you not $300,000 extra, but $400,000, and so on and so on. They're going to bid your salary up until it settles finally at a point where you're earning $500,000 more than an ordinary manager. You don't think that's the way the world works? The example is extreme. It assumes that everybody knows exactly how much you're worth and there are no other complicating factors. But if that were true, then that would be the extra salary that you would earn. Firms sometimes screw this up. The LA Angels bid an enormous amount to hire Albert Pujols from the St. Louis Cardinals a few years ago. Pujols at the time was one of the most productive hitters in baseball history. He was the most feared hitter of his time. I just read a piece in 538.com yesterday that identified Pujols, the very same Pujols, as the worst player in baseball this year. He's hitting 70 points lower than his career average. He's a designated hitter. He contributes nothing in the field. He's a liability. If they replaced him with a rookie prospect, there would the prospect. They have a concept, wins above replacement. You know, he's costing his team 2 wins a year compared to the marginal player they could use in his stead. But they weren't expecting that when they made him the offer. They thought he was going to make a persistent difference in their winning prospects. Sometimes they bid too much, but sometimes they bid too little, and people settle on contracts that are less than the value. But if you don't think the central tendency is what's driving this, then you don't understand the way things work. If you're in a key position and you're 1% better than the next best guy at what you do, and being that much better operates on a scale of earnings, maybe $10 billion a year, you're going to make that earnings pot 1% bigger than before, you're worth big bucks. And if it's obvious that you're the one who's making that difference, people are going to bid for you. And that's not to say that you deserve to make that much money if you're making hundreds of millions of dollars a year by virtue of finding yourself in that position, but that's what you're worth to the enterprise. Maybe we could tax most of that away and you'd still be happy to do it. The evidence seems to suggest that the people who are in that position would be happy to do what they're doing for way less than what they're currently making, because they always used to do it for way less than they're currently making. But that doesn't mean that that's not the way to think about the forces that are driving pay movements.
So then support for the salary cap, maybe we can cash on the table?
The salary cap is just a recognition that individually players are worth much more to teams than players collectively are worth to teams. You know, if you didn't have, if salaries were half what they were, do you think any of the top players would say, no, I'm selling life insurance, hell with that? No, they would all want to do what they're doing. The product would be the same, the fans would get the same value from it, but collectively it might be, you might find better uses for those dollars. It doesn't say that giving those dollars to the owners is better than giving them to the players. It's just saying that maybe you could tax those dollars and people would still do it. The owners wouldn't be any worse off than they are now, and you could pay for flood relief. That might be worth more to society than athletes buying another mansion. Or maybe not, depending on how you look at it. Here's another example. Ford copied GM's idea, or rather the reverse, or they both think each copied the other's idea. They've got the same invention with minor differences, and whether it's a patent infringement or not is too close to call. One invented around the other's patent, and that's legal if it's true. If it's the same idea in too close detail, then the patent office will rule against you. So it's a huge suit. It's $1 billion, and the merits of the case don't enable you to predict who will win. I'm going to assume it, for the purposes of the example, that whichever side hires the better lawyer is going to prevail in this case. The case is a toss-up. If our lawyer is better than your lawyer, we win. And if your lawyer is better than our lawyer, you win. Okay. there are two lawyers at the top of the patent litigation heap. Smith and Jones. They're terrific lawyers. They're unbelievably skillful. There's Smith and there's Jones, and the pertinent fact is that by a small margin, but by enough of a margin to be decisive, Jones is better than Smith. And so in this context, in the way I've set up the example, the assumption is that if you hire Jones, you win. If you hire Smith, he's good too, but you lose because he's not as good as Jones. So the question is, in the market for their services, what's the pay that each will earn? And the no cash on the table principle offers a clear, unique answer to the question. It's that if you hire Jones, you win. If you don't hire Jones, you lose. Jones is going to get paid $1 billion, and Smith is going to get paid 0. Any other numbers? There's cash on the table. If you paid Jones $1.5 billion, where's the cash on the table? If you fired him, you'd be $500 million richer. If you paid him $500 million, and the other side offered him the full billion, there'd be cash on the table. If you offered him the same amount and at least had a 50-50 chance of hiring him. The equilibrium salary for Jones is $1 billion. That's not the way it would ever work out in practice. It's an unrealistic example in the sense that if you hired the better lawyer in a close case, your odds of winning wouldn't be 100%. They'd be, 53% or 58%. They'd go up. But there's enough noise in the process that they wouldn't be 100%. So Smith wouldn't get 0. You hire him, you still got a chance to prevail. Jones wouldn't get $1 billion. You still might lose if you hire him. But they'd each earn a huge bundle of money if they were fortunate enough to be in a position to have a decisive role in a case like this. That's the way market forces push salaries in the marketplace. What are you going to do to the bottom line? If we can measure what you're going to do to the bottom line, there's going to be forces pushing your salary up until we retreat and say, well, actually, given the amount we're paying you now, it's not worth it to keep you because we've already gotten to the no cash on the table point. Economic profit does not drive economic rent to 0. It drives, competition doesn't drive economic rent to 0. It drives economic profit to 0. The no cash on the table principle talks about the payment a company gets that's economic profit. A factor of production can earn a rent forever if it has a permanent advantage in terms of what it contributes to the bottom line. Think about somebody who can, whose vertical leap takes him to here, and then he can take a few steps, attain that altitude, and then, as if by defying the law of gravity, continue in a motion for 20 feet, and then reach up and drop a basketball into a round hoop. He has the ability to do that. That person's going to be worth $30 million a year forever, as long as he can do that. Doesn't matter that you're willing to do it for $25 million a year. You can't do what he does. If you could do what he does, and if lots of other people could, then he wouldn't be worth $30 million a year. The rent can't be competed away except by somebody who can do whatever the factor is that's collecting that rent. If there were a pill people could take that would enable them to do that, he wouldn't get that much. It would be a commodity. Price supports for saving family farms. I'm going to go summarize through this. What's the problem of family farms? They have high costs compared to corporate farms. Why is that? Because there's advantages in scale in farming. If you farm several thousand acres and use huge mechanized equipment, you can bring crops to market for a fraction of what small family farms are able to do. And so the history has been corporate farmers buy up land, they introduced mechanized methods of growing crops. The supply curve of the crop shifts to the right, price falls, and after a time, price falls to the point where no matter how hard the family farmers work, they can't cover their bills. And so they're forced out. And when they're forced out, it's painful for them to be forced out. We see cable news features. The family is huddled together in the rain on a November morning. It's cold. The auctioneer is auctioning the tractors and the lawnmowers and the kids' swing sets, and the family is in tears. They know they got to move on somehow. And these are, by consensus, good people. They're hardworking people. The kids get up at 5 in the morning and do chores. They come back and they do work on the farm. They don't sit around playing video games and smoking dope. They're the kind of people you want to root for. And so when proposals are up for consideration, what should we do about this problem? These are good people. Let's support the family farm by supporting the price of the produce they make. So corn selling for only $1 a bushel, we're going to have the government step in and buy it for $1.50 a bushel. That'll save them, and it does save them for a while. But when the price is $1.50 a bushel, what happens? The corporate farmers see cash on the table. And so they bid for land thinking to scoop up some of that cash that's sitting there on the table, and the land prices go up. And then the farmers can't cover their bills again. So what do? We raise the support price to $2 from $1.50, and on and on and on, all the while doing no good for the people we're trying to help. That's bad policy. There's a film about this. Let me see if I can find that. I've forgotten the name of the film. I'll look it up if somebody wants to know. Sam Shepard was a farmer. The farmer's wife was, who is that? Jessica Lange. Jessica Lange. So Sam Shepard and they're a struggling farm couple. They go through the depths of despair. And they dramatize what a serious problem this is. Then a farm association gets them invited to testify before the House Agricultural Policy Committee. They go to Washington and they testify that there should be price supports for family farmers. And so we enact price supports. That's not good economic policy. Anybody who understands the economics behind a proposal like that would say, no, that's not going to help. You need to have retraining for people. You need to have income transfer mechanisms. But having price supports is just going to transfer more money to the people who own the land. These are actors. They're not people who understand agricultural policy. The point isn't that farmers don't suffer when all this happens. They do suffer. But if you want to do something effective about it, you need to know about the no cash on the table principle before you act. A trucker gets $5,000 for carrying freight across the country. The rent for his rig is $3,000 a week. He spends $1,000 on gas, meals, other expenses, another $500 a week. He could work as a local deliveryman for $500 a week. He likes that just as much as driving across the country and back. So what's this trucker's economic profit? Simple. We do total revenue, take off all the relevant costs, and we get those costs add up to $5,000. His economic profit is $0. There is no cash on the table. This is a stable situation. Then one trucker gets the idea, actually an entrepreneur gets the idea of pitching a product to truckers. It's, you can put this thing on the top of your cab and your fuel consumption will go down by 25%. Why? Because the air won't hit the flat surface of your trailer so hard and slow you down. It'll bounce off that nice sloped surface and it won't be nearly as much drag. You'll burn way less fuel. This thing you can have for $50 a week. I've got a supply of them here. And you're going to save $250 a week in fuel. You interested? Yeah, why wouldn't you be? You'd be nuts not to consider buying that thing. So if you do that, your cost is not going to be $5,000. It's only going to be $4,800. You save $250 on fuel. Remember, it's a 25% savings. And you got to pay for the thing. It's $50 a week. The net change, $200 down on your cost. So your economic profit is $200. Good. But now there is cash on the table. Who's going to want to get some of that cash, and how can they get it? If you can't answer questions like that, you don't understand the logic of the no cash on the table principle. There's cash on the table. Who sees it? What is he or she motivated to do to try to get some of it? Airfoil. So you're a trucker. This one guy, there are thousands of truckers. One guy has this thing. He's making more money than you. What occurs to you? He's no smarter than me. How come he's making more money than me? What can I do? Let me think, what can I do to level the playing field here? He's got one of these things. Can I get one? I bet I could Google and figure out who's willing to sell me one of these. I'll get one too. And then pretty soon, lots of people have these things. And before long, everybody but one trucker has one. Okay? What happened to the cost of taking things across the country now? It's $4,800 for everybody. What happens to the price of the trucking services? It falls so that the revenue you get for doing that trip is not $5,000, but it's only $4,800 now. And there's, again, no cash on the table. This guy who didn't adopt one, his costs are $5,000 still. He only gets $4,800 for, he's earning a loss of $200 by working as a trucker. He's either going to want to get one of these devices or get out of business. So the early adopter can make headway. If you're behind the curve, you're going to actually do worse than you would otherwise. Okay. Okay, so what we see is as fuel prices keep going up, we're going to see an evolution of the technology for trying to cut costs. The first ones of these I saw looked something like that. Why didn't they always have them? Because fuel used to be much cheaper. It didn't pay even to. So that device did almost nothing. But as fuel kept getting more expensive and people did more research, the devices got more sophisticated. And before long, if fuel prices continue to rise in real terms, the trucks will be shaped like needles. That's the no cash on the table principle. If you're in a competitive industry, you have no control over your price, but you can consider ways to reduce your costs. And there's huge pressure on everybody to do that, or else you're going to end up behind the curve.